Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Chicago. Welcome to the show, Fernando Angelucci.
Thanks for having me, Victor.
Well, great to have you here. It's been a while since you were last on the show, and you are deep in the world of storage. I'm excited to get an update, get a perspective on how you see the business is evolving. We're active in this space as well. But maybe for the folks who haven't met you yet, perhaps give a little bit of your backstory and how you got to this point in your journey.
Yeah, I was an engineer, rich dad, poor dad, kind of changed my life, decided I wanted to go into real estate. First started with flipping houses and then upgraded to buying apartment buildings and owning rentals. Then I got fed up with kind of the three T's, tenants, toilets, trash. It was kind of the issue that I had with any facility or any investment I had. I always had some type of problem with the three T's. So then got into self-storage in 2016. Since then, we've been doing exclusively self-storage. We've done over 56 facilities in 24 states, near about $250 million in self-storage assets.
Love it. Now, we've gone through a cycle for sure in the world of self-storage. There was a lot of demand. There was a lot of activity, a lot of movement during the pandemic. It drove many different sectors in real estate, including multifamily apartments, individual single-family homes. There was a lot of asset price inflation, and a lot of that mobility, just naturally as a consequence, drives demand in storage because people rent a storage locker because of an event, not because it's Wednesday. So it's really understanding that piece. And then we on the backside of that, we had the lock-in effect, which reduced mobility. So a lot less activity in the market. How are you seeing the market playing out? And by the way, a lot of primary markets with a tremendous amount of investment from institutional players, from REITs. Many of those primary markets got oversupplied. So there's just a lot of different effects coming together at the same time. What are you seeing?
Yeah. During the beginning of the pandemic, we saw some of the highest year-over-year rent growth we've ever seen in the industry. I mean, we're talking in some cases 80% year-over-year rent growth. And that makes sense, right? Because people can no longer go to work. So now all of a sudden they have to cannibalize one bedroom to make an office. And if they have kids, now those kids have to go to school. They have to cannibalize another office or a living room or a dining room. And all that stuff, they didn't want to sell it. They had to put it somewhere. So they put it into self-storage. So we saw some of record-breaking year-over-year rents and record-breaking occupancy that we've ever saw. The problem was a lot of new investors coming into the space thought that was normal and was underwriting future performance based on this once-in-a-100-year event. And that caused a lot of people to get not only buy deals that were not going to pencil out in the end, but then also oversaturate certain markets because they thought those markets were going to continue growing due to the migrations that they saw during the pandemic. So what ended up happening was, towards the tail end of the pandemic, once we opened up again, a lot of that artificial supply was removed and people moved back into their offices and kids went back to school. And you saw a pretty large slump down, not only in year-over-year street rates, but then also occupancy as well. That caused issues for some and treasures for others. You being able to come in and buy, newly built product for at or below replacement cost. So that was an interesting go around on the self-storage industry. But now what we're starting to see is over the last 3 quarters, rent rates have recovered, occupancy has recovered, and we're actually starting to see positive rent growth and occupancy growth. So I think we're kind of exiting that trough of the self-storage industry and starting to elevate again.
So when you say that, of course, real estate, including self-storage, is always hyper-local. So the way some primary markets are going to perform is going to be very different than secondary and tertiary markets for sure. There's also going to be regional differences as well. Some markets for sure oversupplied compared with others. Why don't we break it down that next layer?
Yeah. So like you said, a hyper-localized business to the point where on average, a customer is not going to want to travel more than 10 minutes from either their home or their place of work to use a self-storage facility. Now, depending on the type of market, it could be as small as a 5-minute drive range or as large as a 15 to 20-minute drive range for the more rural or kind of exurban markets as well. Now, what you ended up seeing is a lot of institutional capital there was a lot of money printing by the federal government, which naturally inflates asset prices because a lot of that money needs to find a home. And due to that, you had some of the large check writers, aka the publicly traded REITs and some of the larger privately held REITs, trying to put out as much cash as they can onto the street in markets that were used to being good, these large Class A markets. And the problem is some of these markets that, let's say, was very open during the pandemic, that had less shutdown restrictions, you saw a large net migration of people moving to these, southeast Florida, Texas, Arizona, these types of markets. And now you're seeing a lot of people dealing with the after effects of large immigration and now moving away from those markets. Either not enough job growth, property taxes increasing rapidly, which is the case in Texas, Florida with its problems on a state level. So you saw this kind of reversal of some of that trend, but now you have these brand new facilities that were built that in some cases were as large as 140,000 net rentable square feet, which in our business is a monstrosity. When I build something new, I'm looking at 85,000 square feet is kind of my sweet spot. Anything larger than that, then it starts becoming a little too cumbersome on the sales side. Those facilities were doing really bad, but it's not just those facilities that are doing bad. When you oversaturate a market, every facility in that market does bad because now everyone's competing for the same tenant flow. And what ends up happening, you have this drive to the bottom on cutting rates and offering promotions to just get someone in the door. That disrupted a lot of what was considered these hot markets in the time, like Phoenix and Dallas Fort Worth and Houston, Miami, Orlando, St. Augustine. So these types of areas now are starting to experience, and we saw this in all asset classes. I mean, look at apartment buildings. I saw during the pandemic, I saw syndicators buying things at a 4 cap and assuming they were going to sell it at 3.5. And now those guys can't refinance. They're losing all of their equity in a lot of situations. I know a lot of investors that lost all of their money. So it's one of those problems that you got to make sure that you're not getting caught in the hype of the market cycle, and really going back and studying large, big cycles to see how this really, a great book that I recommend everybody read is Ray Dalio's Changing World Order. It goes over the last 500 years of economic cycles. And that's something that you can see. And he covers the pandemic of 1918, I believe, and how that affected and how it led to the Roaring '20s and the subsequent depression right afterwards. So, making sure that you're studied up on history to make sure that you're not making the same mistakes that we've saw in the past.
Absolutely. And you're absolutely right. There's so many market cycles. It happened in railways, in radio and television, and of course the internet. The dot-communists were defeated in 2000, 2001. And when you're in that bubble, it feels really good. It feels really amazing. I went through it. I was a leader in the tech industry in 1999 when we took our company public. And man, we're on top of the world, only it wasn't real. Right. So as you underwrite today, and it's not just underwriting new acquisitions, you've got to be underwriting existing assets as well, to look at how are existing assets in the portfolio performing. This might be a hard question. When you have an asset in the portfolio, how do you decide whether to hold or divest or recapitalize or fill in the blank?
Yeah, this is a great question. So one of the things I always look at, and it's kind of a joke, I would say, if I'm not willing to buy my facility at the price that it is right now, then that automatically makes me a seller, right? And what you'll realize is when you have different assets that go through these type of unexpected events like a pandemic or the subsequent trough that resulted of people moving out, you have to start getting creative. So what can we do to increase revenue and lower expenses? One of the things that we've been doing across a lot of our portfolio is adding solar panels, because not only does that offer great tax credits for our investors to use on their K1s, but it also reduces the monthly electrical expense by capitalizing a large event. And I would much rather capitalize something than have it on a monthly expense basis, because on average, for every $100 that I'm able to save, increase my NOI by $100, that increases the value of my facility by $20,000 to $25,000 on average. So what am I looking at? How can we add additional services? Maybe cell phone towers, billboards, scanning services, fingerprint services. There's 30, 40 different additional revenue streams that we've been looking at adding. And then how can we leverage technology to, again, additionally raise revenue or drop expenses. So here's a perfect example. I know AI is kind of the buzzword right now. I think it's the newest bubble, looking a lot like the .com did, 20 plus years ago. But there are things that are coming out that are helping substantially when it comes to manpower, research, time. For example, we use a software that it does three things. The first thing that it does is it goes through an entire rent roll and it looks at each customer and it grades them based on how well they're able to absorb a rental increase. So if you're somebody that pays in cash every month and you're late and you're posting on social media that you're in the hospital and you have a bunch of medical bills, you're going to be scored at a 0 to maybe 3, which is not going to be much of a rent increase, if any at all. Now, if you're somebody that has it on auto pay with Amex Platinum credit card and you have an open social media account that is showing you traveling first class and doing all these extravagant vacations, you're going to be scored closer to a 9 or a 10. And these are the people that are able to absorb a 20 or a 30% rental increase because they just literally don't even see it on their bill. It's such a small cost to them comparatively. And they'll go through and they'll suggest based on the numbering score how much you should increase everyone's rates. That's number one. The second thing that it does is that it will go out and will dynamically price based on kind of the same model that the airlines use. So if all of a sudden we see a massive spike in Google searches for self-storage in a given market, it will automatically change the pricing of our online units, in addition to looking at what our competitors are charging, making sure that we're staying competitive, but still capturing that kind of one-time growth or that growth that comes from some type of an event. And then the last thing that it does is similar to the airline industry, is the kind of the good, better, best. Do you want to sit in the back in economy next to the toilet? Do you want to sit in premium economy with a little bit extra at legroom, or do you want to be business class? It's all the same plane. Everyone's getting to the same place at the same time. So now we start doing this in self-storage as well. Maybe the advertised rate is $100, but that's on the third floor in the back corner, farthest away from the elevator. If you're willing to pay $110, third floor next to the elevator. If you're willing to pay $130, I'll put you right next to the front door on the first level so you don't even have to get into an elevator. And what we find is that anywhere between 30 to 40% will choose an upgraded option, either the better or the best option. And that's additional revenue to the bottom line with zero added expense.
And how do you underwrite that? Because unless you have a tremendous amount of market data, which I imagine at this point with the portfolio you have, you do, but when you're postulating a new facility in a new location that you don't have experience with, how do you underwrite that?
Yeah, so there's kind of 4 different levels of underwriting, 3 of which are internal based on our data. And then there's kind of the 4th level of underwriting, which is third parties. So we go out to our third-party management partners. We have anywhere between 4 to 6 at any given time, depending on what our portfolio looks like. We say, what are you seeing for this market? We would like you to put your hat in the ring to manage this thing. But to do that, I need to see some pretty realistic data that I can hold you accountable towards. So don't give me some pie in the sky number just because you want my business. So that's number 1. And then number 2 is actually hiring a third party feasibility consultant to make sure that I'm not wearing rose-colored glasses. Not only is that great for me to check my own underwriting and my team's underwriting, but then it's also great for instilling confidence in the lender partner as well as the equity investors. They want to see that there's somebody else that is paid up front and has no financial stake in this business saying, yes, this is good, here's why, or no, this is not good, and here's why.
I love it. Now, depending on the market, there's always questions of unit mix. So the rent that you get per square foot obviously varies based on unit size, but then there's the other layer. You talked about position in the building. There's climate controlled versus not climate controlled. How do you decide when you come into a market what the right unit mix is? And because at the end of the day, if you view this through the lens of product design for a specific customer, a college student is not going to rent a 10 by 20. That's not the right fit for that particular customer. Someone who might be running an e-commerce business, a 10 by 20 might be perfect. So understanding who your customer is, how do you decide, how do you segment the market in advance in order to determine unit mix?
Yeah, there's kind of 3 elements to this. So first is the actual market itself and what is around it. If you're in a university town building a facility that's all 10 by 20s, 10 by 30s, it's going to be a problem. People will always look at what is the cost per square foot, but if you build facilities based on cost per square foot, you're going to have a facility full of 5 by 5s, and the problem is those 5 by 5s are going to stay empty. So then the cost per square foot is 0. The rent per square foot is 0 because those stay empty. So it is a balancing act of what is in the local market and what is popular in that market. So the easiest things you can do without even spending any money is first secret shop all your competitors. Go to each one of your competitors, call your competitors, make up a little story of who you are. I'm a college kid, or I have a landscaping business, whatever it is, and say, how many units do you have available? And what I like to say is, hey, I'm not looking for just one unit. I'm a business owner doing X business. I'm looking for 6,000 square feet. What kind of units can you give me to cover that 6,000 square feet? And then if you're willing to physically drive to those facilities, you can actually go around and count locks. You can see which ones are owned, which ones are rental locks, and which ones are manager locks because they're empty. And you can typically, based on the door size and the configuration of either the satellite view or even by walking the facility, you can see how large that unit is that you're walking past. So that's number one. Number two, again, is relying on those third parties. So not only the property managers that are looking to vie to get the business, but then also the third party feasibility study. These property managers, you need to engage them before you build these facilities, because they don't want to manage a facility that has a bunch of unpopular units, because then they are not making revenue off their management fee off of those unrented units. So making sure that you work with those guys. And then the third thing is, I think, this interesting trend of what is popular and what is not popular. Back in the day when storage first started, it was these huge drive-up units. That's what everybody wanted because they were, in some farm town or rural area, and they had a bunch of big toys they needed to store. Then all of a sudden, as we started getting closer and closer to the pandemic, the unit sizes started getting smaller and smaller, and people were willing to pay for a premium for climate control inside of a control access building with an elevator, et cetera. But then now what we're starting to see is kind of a reversion. Those units that you have to use an elevator to get to are usually renting more poorly, and in some cases are carrying a discount up to 15% over a similar size unit on the first floor. So what we started doing now is moving away from building these 3 and 4 story, Class A facilities, opting to get more land and building single story mix of climate control and drive up. And those typically stay rented longer and are more popular, because if you have a pickup truck with housing appliances, a refrigerator, an oven, you don't want to have to first get into a loaded bay, put it on some type of dolly, cart it down a corridor, get into an elevator. Nobody wants to do that. They want to pull their pickup truck right into the back of the unit and just kind of drop it off and maybe move it a couple feet and you're done. So what we've been seeing is that this push towards larger units has been accelerating again. And then even you were talking about the e-commerce, we are now starting to do what we call contractor units, where we run them like self-storage, but they're 30 by 50 units. So we're specifically going after the HVAC guys, the electric, but we don't run it like small bay, because I don't want a fixed monthly rent that's on a 5 or a 20-year term, because then with the inflation that we're experiencing, I get trapped. So I want the ability to move this on a month-to-month basis, and those guys are going to stay forever anyway, until either their business fails or they get so much money that they buy or build their own warehouse. So those are great tenants, and those are a lot of the tenants that were displaced during the pandemic because of the Amazons of the world and this last mile shipping. They took all of that space, and now these guys have nowhere to go.
I love it. Well, it sounds like these larger units are the gateway drug from, or maybe the fallout from the shortage of small bay. Well, Fernando, if folks want to connect, if they want to learn more, what's the best way?
Yeah, if you're a passive outreach type of person, you can go to our website. It's ssse.com. So samedward.com. If you're more active outreach, you can reach me on my cell phone, shoot me a text, or give me a call. It's area code 630-408-8090.
Love it. Well, Fernando, great to catch up. And for the listeners at home, you definitely want to connect with Fernando Angelucci at ssse.com or directly by phone. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.